to care about what goes on in the community and the economic growth of our community. So we really thank you all for coming out today. I'd like to first, if I could, thank all elected officials and have them stand, and dignitaries in the audience if we have any, so I don't miss anyone.
We have one.
We have one?
There's more around here, I saw them.
All right, thank you. I'd also like to thank our sponsors, of course, National Bank of Arizona. My name is James Carr, and I'm the Regional President for Yavapai County. And we've also partnered with Central Arizona Partnership and Yavapai County Contractors Association. And I want to give a special thanks to Deb Carbone and Cece Savage for putting this together. And Sandy Griffiths, thank you for your help. So we really appreciate it. Our first speaker today will be Dr. George Feiger. Dr. George Feiger is the Chief Executive Officer at Contango Capital Advisors. He's also the founder, director, member of Executive Committee, and Chairman of Investment Committee of the firm. Dr. Feiger oversees and coordinates the development and implementation of investment strategies across the firm's increasingly diverse client base. He brings a diverse background in banking, financial, and wealth management industries to the firm. And Dr. Feiger was an associate professor of finance at Stanford University's Graduate School of Business and holds a PhD in economics from Harvard. So with that, Dr. Feiger, I'll let you begin your presentation. Thank you.
I guess that, is this one? Can everyone hear me? Is that working? No? No? Bad news. Bad beginning.
It's on.
Well, that's better. All right, I'll have to hold it. It's a skill I may not have. Anyway, welcome to all of you. I'm very happy to be here as part of this discussion on what's going on. My role in this exercise is the big picture kind of thing. What I want to do follows from the kind of work that we do. We're investors. We invest our clients' money. We have a whole variety of clients. We have small institutions, we have families, we have businesses as clients, and we now have an investment activity which is around $3.5 billion, and we invest in just about every kind of asset all over the world. And the perspective that I'm going to give you is what's going on in the world economy and world financial markets, and it's primarily from the point of view of an investor, but I do want to make some other comments as well. See if this works. Good. So I want to make 3 points. First, we've gone through some very tough times. I think all of you have noticed that this has happened. There is light at the end of the tunnel. Things are getting better, but they're not getting better fast. And you may say, how can that be? We've had nearly 5 years of turmoil. I think things really started getting bad at the end of 2007, and they've gotten better and worse, but mainly worse since then. What I'm here to tell you is that for reasons that I hope I can make plain, we're up for another 1 to 3 years of ongoing volatility. Things are getting better, and in particular they're getting better here in the United States, but we're very far from a situation where you can feel sort of comfortable. I'll make some remarks about what is a prudent investment strategy in the context of the picture that I will paint, and this kind of approach that I will discuss is what we're advising our clients to do. But I want to finish with a few remarks, not from an investor's point of view or the point of view of people who are well off, which is realistically the kind of people who are our clients, but from your point of view as a citizen. And what I will say is that there are some very fundamental structural changes taking place in our economy, which mean that even when we have what everyone acknowledges is a much recovered situation, this will not benefit everybody equally, and there is no reason to expect that it will ever benefit anybody equally for the foreseeable future. And I'll try and explain why that may be. But let me begin by talking about what's going on in the world economy and world financial markets, this issue of the light at the end of the tunnel. I'll begin by talking about the United States. The United States is the least bad place to be in the world economy. The least bad place. This is a compliment when you compare it with what is happening everywhere else. Okay, and I'll try and illustrate that. There are four fundamental things, I think, that make this the least bad place to be. The single most important development for our aggregate economic welfare is the so-called fracking, the fracking of shale, this ability to extract natural gas, gas liquids and oil from shale. This is barely beginning to have an impact on our economy. It is an enormous potential development. We've seen already some of the benefits, but it's nothing compared to what will come in the future. You have to understand that thanks to this, gas will become the single most important fuel, certainly for the next decade or two, and gas here is cheaper than anywhere else in the world. Natural gas in the United States is 1/4 its price in Europe and 1/5 its price in China. It is breathtakingly, overwhelmingly cheap. What that means is that any energy-intensive activity is moving back to the United States, and if you look around, you'll see all sorts of chemical and industrial processes that are energy-intensive are coming back to the United States. This can't happen quickly because you don't build plants overnight, but you will see an ongoing migration of every kind of essentially energy-using high-technology activity back to the United States. You'll see coal being displaced as a power plant fuel, which is very beneficial for the environment, and you'll see a lot of other changes to transportation and so on. This is enormously important. Its effects will ripple through our economy for the next 20 years. The second thing, of course, which is equally important, but probably more important in the long run, is that you sit in the world's most innovative economy. Every gadget that everyone in the world uses is invented here, and I'll go on to explain that even though some of these things are assembled elsewhere, almost all the value added is captured within the United States. So we are the inventors, we continue to be the inventors. There is no other place in the world that creates as much intellectual property of real economic value as we do. That has gone on throughout the recession, and it will continue for the foreseeable future. The third thing is that even though you may think that people like me who work for banks have horns and a tail, which I have tucked in my trousers for the purpose of the presentation, the banking system in our country is in fact the soundest banking system in the world today. It's largely repaired and it's ready to lend. The reason it's not lending more is because there aren't that many creditworthy folks out there. There isn't strong economic growth and there isn't strong demand for credit, but it's getting better. We have a repaired banking system, and I will come back to that point. And finally, of course, we have slowly accelerating business formation, slowly accelerating job growth. You have seen in various media that the growth rate for the third quarter was revised upwards to something in excess of 2.5%. That's an understatement in a sense. The private sector of our economy is already growing at around 3.5% on an annualized rate. The aggregate has been reduced because the government sectors are laying off people left and right. But if you just look at the private economy, while I wouldn't say it was wonderful, it's very far from being bad. So what you have is, again, compared with most other places, a much improved situation. And so we are indeed in a pretty good place. This is a picture of credit conditions. You don't have to worry exactly what it means in the sense of how we constructed it. It's a survey of the willingness of banks to lend. And it starts at 2001. You can see how it plummeted in 2009. And in fact, if you took this measure back, you would be hard-pressed to find a time when banks were less willing to lend than they were in 2009. But you can also see that this picture has dramatically recovered, and it's very much back towards that peak of lending enthusiasm that we saw, in fact, before the crash. There isn't as much volume of loans, but in terms of ability and willingness to lend, that's already repaired, so that the system is actually able to fund much more economic growth than we have today. If you look at global opportunities, which is what we do, and we look at global opportunities in the long run, and I stress long run, I'm not talking about something that's going to be great in the next 12 months. Our horizon for comments like the ones I'm about to make are somewhere between 5 and 10 years from now. If you look at those things, there are enormously interesting things to invest in. I've already mentioned energy and all the downstream benefits in the United States, emerging market equities and emerging market debt, notwithstanding, again, the things I'm going to say in a few minutes. These emerging market countries, China, India, Brazil, Indonesia, Mexico, these are Turkey, I could go on. These are the growth engines of the world economy in the future. We were in the past, we will not be the growth engine of the world economy in the next 20 or 30 years. These places will be, and there are increasing opportunities to invest not only in the equities but in the debt of these places. And in many cases, the debt of these places is better quality than some of the stuff you can get here. Remember, I live in California. Global blue chips. As the crisis unwound, we in fact pulled most of our investments back into the US. In 2010, we pulled everything out of the European Union. In 2011, we pulled practically everything out of the emerging markets. Most of our portfolios are concentrated in American investments and in global blue chip companies, companies like Caterpillar and so on, that sell all around the world. There are others outside the United States that are also blue chips. These are companies which can take advantage of growth all over the place, which pay dividends and so on. There's technological innovation. I've mentioned that already. I'll mention it again. Infrastructure. Again, I live in San Francisco. If you drive in San Francisco, you do the slalom because you have to avoid the cars swallowing potholes. Our infrastructure in this country, in fact, we are living on borrowed time. We are living on the infrastructure we built in the 1950s and 1960s, whether it's the highways or the railways or the colleges. This stuff all has to be renewed. That's true in many other parts of the world. Infrastructure investments are very nice. They yield relatively constant income. And there are distressed European assets which are appearing in increasing numbers. Remember, to one person's carcass is a vulture's dinner. There is always a way of making a good time out of bad things. And that's part of the business that we're in, and there are more and more of these kinds of assets. So when you look at this, you say, yes, actually, if you have the long view, there's really a lot to invest in that has a lot of economic promise. And that's, you know, if you look at our portfolios, where they are today, where they've been and where they're going, this is the sort of stuff that we're investing money in, and this has a lot of promise. But there are a lot of problems, and before you get to the promise, you have to deal with the volatility, the risks. And there are three main areas of risk that I want to discuss. The first is the eurozone. The eurozone is the single currency zone in Europe. That is the single most troubling part of the world economy today, despite the fact that every now and then someone pops up and says, I'm a European something or other, and we fixed the problem. It isn't fixed. And there are reasons why it isn't fixed, and I think you have to understand that, not only because it's very important in terms of its effect on us, but because there are some very disturbing parallels between what's going on in Europe and what's going on in our country, and we need to understand these things. And finally, I'll turn to discussing what's happening in the United States. Let me talk about the eurozone. The eurozone is the single currency zone. That's 17 of the 27 countries in the European Union share a common currency called the euro, and this was all put together at the end of the 1990s, and it was a dumb idea at the time, and so it has proven. It has turned into an absolute disaster. What you had was a whole lot of sketchy countries. Is there anyone from Greece in the room? I make a lot of jokes. I actually got in trouble a couple of weeks ago. I'm repenting. Okay, so there are no Greeks, so we'll continue with the original script then. So you've got a whole lot of sketchy countries that moved into a single currency union with Germany. The Germans are sober, serious people, and their currency was a sober, serious currency, and they ran the place in a sober and serious manner. And then you had people like the Greeks and the Italians and the Spaniards and so on, and they all joined together. And so if you think back to 1999, the Germans were able to borrow, the German government was able to borrow, let's say, at 4%, and the Greek government, for similar maturities, would have had to pay 14% for a similar loan. There's a reason for that. You don't need me to explain it. But when all these countries all got together in this single currency, everyone assumed that all sovereign debt was the same. It's a government, it's government debt, it's good for it, so they're just as good as the Germans. So the borrowing cost of the Greeks and the Italians and the Spaniards and the Portuguese and all these other happy folks, they all went, as it were, from 14% to 4%. So all these people said, wow, we can borrow for practically nothing. Now, you could think of several things to respond to that, but they responded in the American manner. They borrowed. Okay? And what you had was a massive, massive credit boom in all of these European countries. And you may think we had a real estate bubble in the United States. We had nothing on the Spaniards, nothing on all of these other people. They had a much bigger real estate bubble. The Brits had a huge real estate bubble, and they weren't even part of it. But they benefited from similarly good credit conditions. And so you had a situation where in Spain, which has a population of about, I think, 1/7 roughly of the entire Eurozone, they built as many new houses in Spain as in the rest of Europe put together. And I could go on with these sorts of statistics, and in addition to spending money on real estate, which of course sober people in America would never do, they also spent a lot of money in the public sector, increasing welfare benefits, letting people retire earlier. Again, to go to Greece, which was the extreme, in Greece people tend to retire on the equivalent of social security, and so it turned out that in Greece you could retire, if you were a hairdresser, you cut people's hair for a living, you could retire at age 50 on a full pension for the rest of your life because you were in a hazardous occupation because you used scissors. And now this isn't funny, this is literally the case. And so you had this massive explosion of wasteful private investment and an extraordinary set of things which raised the cost of labour, essentially. You know, all you did was give people more and more benefits, and I won't go into the details, it cost more and more to employ them. This means it's very uneconomic to make anything, and if it's uneconomic to make anything, it's hard to earn anything. So you had this massive bubble, and then you had an absolute crisis that erupted when the whole thing collapsed. And what is the crisis? And this is something you have to understand because it has many domestic parallels. First, the first level of the crisis is a near insolvent banking system. Virtually every European bank that you can name, from the biggest to the smallest, by American standards of accounting, is either actually insolvent or has capital at a level at which the FDIC would seize it. This is an extraordinary statement, but virtually every one of these banks is actually insolvent. Now, why is this? It's a complex set of reasons which is not that hard to explain. The first thing is these banks were too highly leveraged. If you looked at US banks in 2006, before the crisis, you would see that an American bank, on average, had 6 cents of capital for each dollar of assets. That is, it loaned 16 times its invested capital. The banking system is a very risky business, as you've probably noticed by now. So American banks were leveraged 16 times. At the same time in Europe, they were leveraged 25 times. So if we had a 6% cushion against losses, the Europeans started with a 4% cushion against losses, significantly less. Then they made all those bad loans. You know, they made all those loans on those buildings in Spain and Portugal and all the rest of this stuff. And in addition to those loans, there were our loans. So, you know, all those lousy mortgage-backed securities that aren't sitting in your 401k plan are sitting on the books of these European banks. They bought them all because Moody's and Standard & Poor's said they were all AAA securities. So they've got their own bad loans, they've got our bad loans, and in addition they've got loans to all of these European governments. Because one of the fundamental differences between the economy of the eurozone and that of the United States is that the bond market is much less important in Europe than it is here. So when governments borrow here, they tend to issue bonds. Take the state of California, for example. It issues debt. Arizona issues debt, and so on. In Europe, the market for bonds is much smaller, so governments borrow from banks. So, which brings us to the governments, which is the second level. These governments have what are called exploding debt obligations. Let me explain what an exploding debt obligation is. It's not complicated. So imagine a government. A government has revenue, it has taxes and stuff like that, so it brings in the revenue, and then it has regular expenditure. You know, it pays for the Army, the Navy, the Air Force, all the rest of this stuff, the Boy Scout subsidies, and so on. And the difference between the revenue and these regular expenditures is the amount of money that's left to pay the interest on the national debt, right? That's what's left. Now, suppose that the amount of money left isn't enough. What these European governments did was borrow to pay the interest. Well, if you borrow to pay the interest, the debt's bigger the next year, so you have to borrow more, right? And this is compound interest working in reverse, and that's what's an exploding debt obligation. So you have to understand that virtually every country in the eurozone is in this situation today. Their revenues are actually, they're all running, almost all of them are running deficits. So their revenues are actually below their expenditures before debt service. And they are all borrowing in order to pay back, to pay the interest. And they're heavily borrowing from the banks. And these are the banks that they're subsidizing because the banks are bankrupt. Now you have to think about that for a little bit, because it involves an act of levitation. Okay, so you understand, not only are these governments incapable of raising enough revenue even to pay their own debt, but they are supporting the banks which are buying the debt that they can't pay the interest on. This is literally what is happening in the European banking system. This is why the debts of the governments and the banks keep rising. But those are not the biggest problems. The biggest problem is actually the third problem, which is uncompetitive costs of production. I went back to the Greeks, and I'll use that as an extreme example. So Greece became independent from the Ottoman Empire in the late 1820s. The Ottoman Empire, remember, was Turkey, yes? And so every time since it's been independent, every 20 or 30 years since the late 1820s, Greece has defaulted on its national debt. Greece is an interesting place. I always think of it as the Argentina of Europe, or conversely, I think of Argentina as the Greece of Latin America. I wouldn't recommend you buy the bonds of either. But in any event, what happened was that this process of becoming uncompetitive, having excessive compensation and then so on, and rendering themselves unable to sell anything. This has happened in cycles in all of these countries. Before the formation of the euro, they just devalued the currency, reset the clock, and started over. Once you're locked together in a single currency, you can't do that. So as they increased the cost of employing labor and all of this, all these countries became increasingly uncompetitive. And this is in contrast to Germany. I'll show you in a moment how big this difference is. So you have this paradox that despite the fact that German industrial workers on a pay-per-hour basis are the most expensive workers in Europe, it's cheaper to produce most things in Germany than it is in Spain, because the productivity of these workers is so much higher that the actual cost of producing per item is lower. And this is because of the foolish policies that all of these European countries followed. This is a measure of the productivity differences. We're looking at unit labor cost differences. So what you can see is between 1999 and 2011, the cost of producing something in Germany fell nearly 20%. That's that top line. In Greece, it rose 10%, so the difference increased 30% in 12 years. You can also see that for virtually every other major economy in the European Union, the cost of producing something rose from 1999 to the present. So each one of these economies has become less competitive relative to Germany, but they're all locked together in one currency, and so they can't devalue. So what has happened is that the German economy has boomed, relatively speaking, and these other economies have struggled because you've had to choose where to produce something. You know, you would end up producing it in Germany and not employing anybody in any of these other places. Happily, they're all employed in construction. But that stopped for some reason. So this is the fundamental competitiveness problem. And then the whole thing was compounded by the cure. And this is where we get some very strong parallels with what's happening here. So what you have is a European situation in which you have all these countries which are in trouble and where the governments are running deficits and it's all awful. And what you have is that the Germans come along and they say, you want us to subsidize you and get you out of this. We have to follow a policy of austerity. We have to raise taxes and we have to lower government expenditures. There are strong parallels to the Republican Party, but as a banker, I do not talk about politics. So when you go to an economy that is struggling with recession, and you go to them and say you have to raise taxes and lower expenditures in order to reduce the deficit, what happens? I won't ask you to fill in the form. What happens is that the economy shrinks. It goes further into recession and the deficit increases. Why does the deficit increase? Well, there's less income, so there's less income tax revenue, and there are more people on the dole, so there's more expenditure. So next year the Germans come back and say, you promised to reduce the deficit, but it increased it, so we have to have more austerity. So this brilliant solution is causing the entire eurozone to spiral into recession. And it's even affecting Germany because a lot of the German exports are sold to these other people because they can't afford to make them at home. And so as they get poorer, they're not even buying from the Germans. So this whole brilliant solution of austerity is driving the whole thing down into the ground. This is a brilliant action which we can all think about. So this is what's happening in the European, in the Eurozone and in the European Union. Now, getting back to the uncompetitiveness, I said all these countries devalued. Hypothetically, you could figure out the exchange rates at which they could operate again as a normal economy. And this picture shows that. Let me explain to you. Today, it's roughly $1.30 per euro. You know, if you want to buy euros to take a vacation, it's about $1.30. It's been around that for a long time. So it varies a few cents up or down, but roughly $1.30. What I'm telling you here is that the German economy is so productive that if Germany had the old Deutschmark back and was on its own, we would be paying around $2.20 per Deutschmark. On the contrary, however, if you looked at Portugal and Greece, they would be below 50 cents. So you see, they're all locked together at $1.30. For the Germans, a balancing number is $2.20. For the Greeks and the Portuguese, it's something like 50 cents. This is a completely unsustainable, unstable situation. This cannot go on, and it won't go on, but I don't know in which way it will stop going on. The obvious thing to say is, well, you know, why is this happening? Why are the Germans doing this policy of austerity? You know, we think we're pretty good, but I can tell you I didn't discover any of this analysis. Right? I didn't invent any of this. You're not the first people to hear it. Everything I've said is totally obvious to anybody who looks at this. Totally and utterly obvious. So then you say, well, why in the world would the Germans do this? And again, with strong parallels to what's happening in our country, The only rational strategy to keep the eurozone together is to spend today and save tomorrow, which is you go to all these places and you say you've got this awful uncompetitive situation, you've got a government that can't afford to operate, we're going to lend you the money today, and over a period of several years you're going to restructure the economy, you're going to get rid of the union agreements, you're going to do all these things to make this system work better. So, you know, we're not going to drive you into recession today, that even hurts us, but we're going to give you money and in return you're going to do all these good things. Sure you are. So if you read the German press, I read the German press, it was my native language after all, so fine. What the Germans say is sure you will, right? Yeah, we're going to give the Greeks money today, and 10 years from now, they'll have cut all their benefits, fired all the public workers, forced all the people in the unions to earn less, and we'll all be happy. Sure you will, you say. We believe you. We do, honestly, hand on heart. So what you have is this paradox that the problem with the eurozone is not that no one knows what to do, it's that they don't trust each other. You know, spend today, save tomorrow requires a high degree of trust. There is no trust between these people in the European Union, and you can see they're right. France tossed out Nicolas Sarkozy, even though he had that beautiful wife, and they replaced him with the socialist François Hollande, and what is the first thing he did? He lowers the retirement age and raises the benefits. Well, you know, how stupid are these Germans? They're not going for this. You see what I'm saying? So everybody knows what to do, but everybody also knows that nobody trusts anybody else. And if this sounds familiar, it should. This is the situation in our country too. Spend today, save tomorrow is a difficult sell. But remember, the alternative is awful. So you are between a rock and a hard place in this situation. Now, why do we care? Is this more than a discussion before you take your tourist trip? Yes, unfortunately it is. We have a huge amount at stake here. First of all, the European Union is one of our big export markets. If your customer is doing badly, then you do badly. In addition, you have these periodic crises, right? There's some panic, the Greeks are going to default, this and that. You notice we have big currency changes, the stock market collapses. They're a constant source of volatility, and this isn't going away. You also have slower growth in the emerging markets. We export a lot to the emerging markets, the famous Caterpillar, all these other companies. The European Union is China's biggest export market. We are not. You may think we are, but we are not. The Chinese depend more on buyers in Europe than they do on buyers in the United States. Europe is in recession. China is having a lot of economic problems because you can't export stuff to people who are basically rioting in the streets because they can't eat. So you've got slower emerging market growth. Everything is connected. The world economy is slowing down today very significantly because of this nexus of problems originating from Europe. And so we think for several years more, this is going to be a drag on growth. There's going to be periodic volatility, you know, periodic crises. We're coming up to another one. The key date, actually, there's been a lot of can kicking. The Greeks have been handed another $40 or $50 billion. Why? Because there is a German election next September. And nothing bad is going to happen in the eurozone before next September because Mrs. Merkel wants to get re-elected. After she's re-elected, then the Greeks have to watch out. But at the moment, they're on a gravy train. But it's a short-lived one. And of course, it's Groundhog Day, the movie. What will actually happen here, right? You know, every day, you have a crisis, then someone like the Mario Draghi, who runs the European Central Bank, says, we're going to do whatever it takes to save the euro, and then he does nothing. So then it's Groundhog Day, and we start over. And so what's going to happen? I don't know, but this is going to go on for years, not for months. And probably the Greeks are going to get tossed out because they're in the worst situation. I told you the exchange rate between the euro and the dollar is about $1.30 to the euro today. If this thing is going to be saved, even without the Greeks, it's going to probably have to fall significantly, maybe on a one-to-one basis. But these are the sorts of things that are coming out of Europe today. So let's move on to talk about the emerging markets. The emerging markets are the growth engine of the world. I've said that before. You know, we're talking about China, Brazil, Mexico, India, Turkey, all of these places. Indonesia, they have great growth prospects. They have young populations. They can borrow the technology we had to invent. They can assimilate it faster. They've had a great burst of growth, but things are bad now. The picture you have here is debt. Debt is a constant theme of mine, unfortunately. This is the ratio of bank credit to GDP in all of these countries outside Japan. You remember in 1998 we had an emerging market debt crisis. Some of you seem old enough to remember that. It was a huge crisis. It came from too much debt. You can see now that the ratio of debt to the size of these economies is even bigger than it was in 1998. How did that happen? Well, when we went into our crisis in 2008, you may remember that all of these emerging market countries, which had learned their lesson from 1998, were not heavily indebted, and so they were able to stimulate the economy by, borrowing a lot and spending lots of money, stimulating construction and this and that and the other, and they borrowed a hell of a lot. That's all I can tell you. They borrowed a hell of a lot. We have taught the world a lot of lessons. This seems to be the most enduring one. And so now you have this absolutely massive amount of credit, and this went on not only in China, which was extraordinary. In China, in 2008, the government controls the banking system in China, and it caused credit to grow by 40%, 40% of GDP in 1 year. This has never happened in the history of the world. I mean, this was a massive expansion of credit. The same thing happened in all of these countries to a greater or lesser extent. And when you have this massive credit bubble, then the same things always happen. You have bridges to nowhere, railways to nowhere, everything to nowhere. Give you an example of real estate, because real estate is close to the heart of every Arizonan. In China today, you have 65 million empty dwelling units built on speculation. Now, to give you a feeling for that, in the entire United States, there are roughly 95 million single-family houses and 40 million apartments. So roughly an amount equivalent to 2/3 of the entire housing stock of the United States sits empty, built on speculation. There are whole cities that are empty. There's a city called Ordos, a city for 1.1 million people, which is like a scene out of a science fiction movie. It is a whole structure, apartment buildings, shopping malls, everything, and it's totally and utterly empty. There isn't anybody there. There are railroad lines and all of this. There are airports with no air traffic, railroad lines with no traffic, and in varying extents this is true in all of these places. Now, the problem with the bridge to nowhere is eventually it catches up with you. This is a picture of what's happened in China since that boom. What you've seen is that there's been 3 years of falling growth. Now, it's true, it fell from 12% to 7%. We should all be so lucky, but it fell. It absolutely fell. And there are two lines on there because I want to make another point. The blue line is the official line. It's a Purchasing Managers Index. This all starts in 2009 and goes up to a few months ago. The blue line is the official line. It looks better than the red line, which is from the Hong Kong and Shanghai Bank. The important point here is that government statistics from China are lies. They're all lies. They're politically manipulated. This is true of many of these countries, particularly the case in China, because the consequences of not doing the right thing can be fatal, literally. And what you can see is that the red line is telling you that China has been contracting quite rapidly. That is to say, the growth rate has been slowing. Other places like Brazil have actually had contraction for 1 or more quarters. Growth rate in India has slowed. Growth rate in Indonesia has slowed. I can run through every emerging market country you've never heard of. South Africa, all of these places have slowed down dramatically. So they are the place of the future, but they're not the place of the present. And remember, if South Africa isn't digging, then Caterpillar isn't selling diggers. So all of these things have dramatic ramifications on us and on the whole world economy, and if they're not getting rich quickly, they're not buying Mercedes-Benzes, so these things ripple all around the world. So this is what's happening now. I don't think it'll go on forever. They are the growth engine of the future, but they're not the growth engine of the present. And this is something that you have to keep in mind. And there are other things that are really quite fundamental that are going to slow the recovery in these places. Probably the single most important one is massive and utter corruption. You cannot imagine how corrupt all of these places are. In China, for example, China is ruled by a kind of aristocracy, the families of the people who went with Mao on the Long March in 1936. The guy who's going to become the new leader of China was recently revealed by the New York Times, whose website was immediately blocked in China, that this man, whose official salary must be $50,000 a year, his family has a net worth of $2.7 billion. That's pretty good. How do you get $2.7 billion being nobody in China? Well, you can work this out without my assistance. But he's not the only one. And you go to all of these places. You look at India. India is a democracy, everyone says. It's not like China, right? India is a democracy, but India has horrible corruption problems, massive corruption problems. They auctioned off licenses for mobile telephones, and had to recall all of the licenses, 30 different licenses, because everyone bribed government officials to get the licenses. And now the telephone system in India is in a terrible shape because no one's putting up anything because you can't find an honest way to actually find a contractor. And I could go on. The famous Enron built a power plant in China, in India rather, which is similarly laced with corruption. And I go through all of these places. So you've got corruption, you've got looting of the state, you've got lousy infrastructure. Indonesia is a wonderful place in which to do business in many ways, but if you go to the ports in Indonesia, what you see is ships stacked up to the horizons. There aren't enough docks, there aren't enough cranes. This is not an intellectually challenging problem. You could build more docks and cranes. Why don't they do it? Well, the money starts going there, but somewhere between the bank and the port, it disappears. It just disappears. So you start with $1 million, you end up with $4.21 that gets to buy a dock. And no one quite knows how that happens. So all of these are problems that we have had in our fair country at various times, and they will be overcome, but they won't be overcome quickly. These are massive, sometimes amusing, sometimes not problems, but they take years to overcome. So the emerging markets have a long burst of growth. It's slowed down now. If you are investors in Chinese stocks, you should be sorry. The Shanghai Composite Index has fallen for 3 consecutive years. This will turn around. In fact, we're actually looking for a turnaround sometime next year. But it's not working now. Everywhere you look in the world economy outside the United States, things are getting worse rather than better. And this is something to keep in mind. Let's talk about America. Some of you have heard me before, have seen this picture. This is what I think you should put on your bathroom mirror and look at every morning. This is total non-financial, domestic non-financial debt relative to GDP. This picture starts in the end of the Second World War, but I can take it back, in fact, to the beginning of the 19th century. I can take it back to the American Revolution. This is what is total domestic non-financial debt. It's really easy. You add up the borrowings of all households in America, the borrowings of all companies, public and private, and the borrowings of all levels of government, state, local, and federal, and you divide that by the GDP, so you scale it for the size of the economy. So of course, the number of dollars gets bigger, but this is relative to the economy. What you can see is we have never in our history been so indebted. Not by a little amount, but by an enormous amount. You can see that for a very long period, the aggregate level of indebtedness relative to the economy was around 130% of GDP, that's that stable bit. You can see it made 2 massive jumps. The 2 jumps are called the Reagan administration and the Bush administration. I didn't make these numbers up. Virtue is easier to talk about than to practice. In any event, I'm not making a political speech, I'm showing you the numbers. This is very important to understand because no one in politics puts this picture up. But this is what we've got. What you have is, I can say the flat bit is Clinton. However, this isn't government debt. This is aggregate debt of the society. It's very important to understand this is not the federal government run amok. This is, in fact, the indebtedness of the entire society. This is household debt. Total debt of all households in America from 1960 to the present as a percentage of GDP. Look what happened to this. This is staggering. This is corporate debt, business debt. Add up the borrowings of all businesses, public and private. Look at how much that's grown. Everybody says the corporate sector is flush with cash. Yes, it's also flush with debt. Corporate America has never been so indebted in its entire history. You have to understand, this country is utterly and totally saturated with debt at a level that has never been seen before, not by 5% or 10%, but by multiples. This is the single biggest problem in the United States. This massive, overwhelming amount of debt. It explains why the recession has been so enduring, why recovery is so slow, why the unemployment rate is so high. These are just the facts. This is an extraordinary achievement. Now, you've got to praise the country. We're patriots. It's very important to understand the implications of debt. These pictures are a result of analysis of cyclical experiences in lots of different countries over lots of periods of time. A couple of economists looked at how long it takes economies to recover once they enter recession if they've had a lot of debt versus ones that have not had a lot of debt when the recession started. And on the left you've got GDP growth. And the top line is low debt countries. So if you have very little debt, you get a bit of a dip and then the economy starts to grow again. If you start with a lot of debt, it takes years. On the right is unemployment. The low line is when you have a low debt country, you get a jump in unemployment a bit, but not a lot, and then it stabilizes. Whereas if you start with a lot of debt, the unemployment rate rises and rises. Why? Because the usual method of dealing with unemployment is for the government to spend a lot of money, right? It spends a lot of money, and so it employs people, and then the private sector sees, oh, people are buying, I'll spend too, I'll invest. It's the jump start for the economy. But given the amount of debt in our system, you can't jump start it. We're all worried about how much debt there is already. You know, the logically correct answer for the US economy today, as for the Europeans, is to spend today and save tomorrow. But if you start with a lot of debt, it's a hard case to make. And this is not true only in America, it's been true everywhere in the world. It's been true everywhere in the world where these sorts of events have taken place. And so now let's turn to the fiscal cliff before I move on. We know what the fiscal cliff is. It's all the taxes are going to rise, the expenditure is going to be cut, and this is like austerity, right? Mrs. Merkel has come to town. And she said, oi, boys, she talks to the boys, because she's the only woman. She says, "Oi boys, you know, you've got a deficit here, we've got to raise the taxes and cut the spending, and this is going to be awful. If the whole thing goes ahead and isn't checked, everybody agrees there will be a recession in 2013. It won't be a terrible one, it won't be like what happened before, but it'll happen. And so then the question is, what will the Congress do? I'm not a particular expert on what the Congress does. You can tell I admire them. I'm sure all of you do too. These must be your favourite people. But nonetheless, there are a couple of things that could happen. Either they will reach a deal before the end of December, or they won't. This is what they call analysis in academia. That's how I got to be a professor at Stanford. You know, if you say things that are sure to be right, everyone says that's right. Anyway, so one of these two outcomes is going to happen. I attended a conference in Washington about 2 months ago of people who were really well connected, and their theory was that in fact probably nothing will be done, but very quickly afterwards there'll be some negotiation which will be retroactive to the beginning of the year, and things will be fixed. I won't make any more comments about that, but the only thing I will say, and this is serious, this is a very dangerous game to play with 300 million people. Right? This is a very stupid and dangerous way to run a big country which has still got a lot of problems. So they're all playing the games. I'm going to be the winner. I'm tougher than you. This is chicken. Everybody's playing chicken. And that's all great if you're just running two motorcycles against each other on a country road and someone's going to turn or not. But this isn't a country road. This is a big economy. A lot of people depend on this. This is not how you run. This is not how you run a government. So I'll talk a little bit about what you do to invest in an environment like this, and then I want to talk about some of the bigger social structural changes. What you have is this very interesting situation where you've got a lot of problems, but a lot of long-term promise. I began by talking about the light at the end of the tunnel, all of these positive developments, the energy, the technology, all of these things are real, at the same time that all this rubbish that I was talking about is going on. So you've got this very difficult problem. On the one hand, you can see there are a lot of promising things. On the other hand, you've got to wade through this god-awful mess to get to this set of interesting investment opportunities. And this is a very difficult issue to handle. And, you know, the positives of the future I've already listed: energy, emerging markets, global blue chip companies, infrastructure, the vulture dinners. And you've got all these problems, the domestic fiscal cliff problems, what's going on in Europe, these emerging market problems. You've got to balance all of that. This is very difficult to do. And what we're talking about with our clients, and what I would advise all of you to do on a personal basis, is this. You've got to distinguish between the near term and the long term. And what you have to do is look ahead, and we talk to people about a rolling 3-year horizon. You've got to look ahead personally for 3 years and say, what are the big expenditures am I going to make? Am I going to buy a condominium in Maui? Am I going to start a business? Am I going to send my kids to college? What are the big block sums of money? And you have to have enough to meet those obligations. So you have to put that amount of money in a portfolio whose main purpose is capital preservation. You're not looking for yield. You know, it's going to make 0.5%. So what? When you write the check to Yale, there's a balance on which to write it. After you've done that, what's left is what you can invest for the long term. And the long term can be very positive, as I said. But, you know, even though we're investing in all of these things, a portfolio with all those promising things, I am sure will be worth a lot more in 5 years or 10 years than today, but I'm not sure it'll be worth more in 5 months. In 5 months, we could have had another explosion in Europe and everything could have fallen a lot. So you've got to distinguish between the money you need and the money you're taking for the long run, and you cannot write checks on the money for the long run. You just can't do it. It won't have liquidity, its value will fluctuate. And that's the only way to deal with a situation like this, is to do a lot of personal financial planning and to be very careful. You should invest for the long run, but not money you want to spend next week, because that money may not be there for reasons outside anybody's control. Now let me turn to this last point about being a citizen versus being an investor. We invest money. We invest $3.5 billion of other people's money, and we're actually quite bullish on the long-run opportunities. We're much less bullish on the situation from the perspective of a citizen than we are from the perspective of a wealthy citizen who is an investor. And let me try and explain what's going on in our economy and why I say these things. The first and most fundamental problem is the decoupling of economic growth from mass prosperity. Most of our political leaders speak as if we could get the economy growing again, everybody would be better off and we'd all be happier. And what I'm going to tell you is that getting the economy growing again is not going to make everybody happier. We are creating a two-class system here for reasons that are quite fundamental to the nature of economic growth, and this isn't going to go away even if the growth rate goes from 2 or 3% to 4 or 5%. That problem won't be solved. Look at this picture. This is a picture of industrial production, which is manufacturing and employment. It comes from 2009, but the situation is exactly the same today. You don't need to look too carefully. The green bars are the value of industrial output, and the yellow bars are the number of workers producing that industrial output for these different countries. The only important thing to take away from this picture is the ratio of the length of the green bar to the length of the yellow bar. What you can see is that we live in the most productive industrial economy in the world. Very few people produce massive amounts of output. Massive amounts of output. Industrial productivity in this country has increased at an enormous and accelerating rate. An enormous and accelerating rate. You'll see the bars for China. In 2009, China produced a little less in value. Now it's a little more, but look at the number of people it takes to do it. Look at the bar for Russia, tiny green, big yellow, 4 people to screw in a light bulb. Productivity is the basis of per capita income. We live in the most productive industrial economy in the world, but we do not employ many people, and the number of people employed in manufacturing relentlessly falls. Before the recession, during the recession, and if you think this is after the recession, the number of people producing anything in this country has fallen, and the level of output keeps increasing. Right? It takes 12 labor hours to assemble an automobile. The robots weld, the robots paint. Everywhere you look, you see increasing productivity. Everywhere. This is the most innovative, productive economy in the world. We're going to discuss the implications of that in a moment. Here's another picture. The thing at the bottom is almost illegible. It is a robot strawberry picker. Now, if any of you have ever picked strawberries, you will realize you can squash them. And you do not think of a mechanical object being able to pick strawberries or grapes. The robot strawberry picker has foam fingers, ladies and gentlemen. This thing has 3 cameras and 2 arms, and it picks strawberries without harming the strawberries. I could show you photographs of robot grape pickers. The famous immigrant labor problem in this country in the next decade will be largely solved by technology, not by politicians. This is a very important point to understand. What we are doing in this country brilliantly is displacing labor and producing more with less. We have a client in California who is one of the largest cilantro growers in the United States. The cilantro, this lovely little herb, is picked by hand at the moment. It's grown on elevated beds in 3 parallel rows, and people pick it. There is a machine. There is a machine which is like Edward Scissorfingers. You grow the cilantro in rows of 12 rows at a time, and this lovely thing with its scissor fingers comes along and cuts it and sucks the leaves with a vacuum, and you don't need a person. It's almost at break even today compared with employing labor. So we could go on forever, and we can continue down this path because it's even bigger in the service industries than it is in manufacturing and agriculture. Remember, in agriculture, we have 2% of our population is employed in agriculture. We're the biggest agricultural producer in the world. Those tractors on those wheat farms are driven without drivers by GPS. Remember that. Everything is done with enormous productivity. In the service industry, it's the bank branch you don't use, the online reservations. In an architect's office, there used to be an architect and draftsman, right? Now the computer does the drawings. If you want to manufacture something, you do computer drawings and link to a manufacturing machine. You don't have any intermediary steps. I could go on forever, but you get the point. We are living in the most productive industrial economy in the world. Right? The most productive industrial economy in the world. And let me explain about what the economics of this are, and I'll use the iPhone. The iPhone was infamous because everyone said, oh look, in Foxconn in China, remember they're assembling it, and all their workers are starving to death and all of that. So let's do the economics of the iPhone so you understand how this works. Apple sells an iPhone to the telephone companies for $600. You don't pay $600 because you sign up for the 2-year contract at $100 a month. That's your problem. But from Apple's point of view, they get $600 for the iPhone. The assembly cost in China is $12. Okay? $12. $200 goes to manufacturers in Taiwan and in Japan for the touch screen and all those other lovely things, and $400 roughly goes to the people in Cupertino who designed it, who do nothing else but design it. If you've ever owned an Apple product, you'll see the little thing at the bottom says designed in Cupertino. You may remember this on the packaging, yes? All of the value added is captured in Cupertino. Do you understand how this is? The economics of this thing are overwhelming, right? Overwhelming. And all of these gadgets have similar kinds of economics. The creative process, the design process, the engineering process captures the value added. Yes? This is the phenomenally important thing that you have to understand. If you have this concentration of income in fewer and fewer hands. So if you go down this path, you find some interesting results. We have a weekly publication called Heard Off the Street. You can get it from the bank. And the last one, which came out yesterday, actually shows you how this works geographically and labor-wise. But roughly speaking, 40% of the labor force of the United States benefits from the processes I've described directly and indirectly. 40%. This 40%, moreover, is not randomly spread over the country. It's in a few largely urban areas. Our productivity growth and our economic growth is driven in a small number of cities. It has two main drivers. One is the energy complex. The energy complex. From Houston all the way through North Dakota, you see enormous productivity growth because of that fracking that I started talking about. Otherwise, it's the famous tech. I live in San Francisco, right? San Francisco is booming. To rent a one-bedroom apartment in San Francisco costs $3,000 a month. Okay? It's stuffed with people who are getting paid enough money to pay that for a one-bedroom apartment. Right? It's got software investment, it's got biotechnology investment. You go to Austin, Texas, you go to the Route 128 corridor around Boston, you go to Brooklyn, you go to parts of the manufacturing area which have been revitalized by the technology. I've got a map in this document which shows you. So these urban clusters are where all the economic growth is, and the rest of the country is what's stagnant. And this is a consequence of what I'm describing here. This is the economy of the future. It's enormously productive. We're more inventive than anyone else in the world. It produces more, but the rewards accrue to the people who create it, right? So if you design the iPhone, you collect the cash. Otherwise, you're a jack-in-the-box. I give you a statistic for jack-in-the-box, because it's a very important point you have to understand. Everyone thinks our problem in this country is unemployment. It's not unemployment, it's income. It's income. In 2011, the average wage in manufacturing in this country was almost exactly $1,000 a week. Almost exactly. The average wage in the hospitality industry, which is the label for Jack in the Box, was $380 a week. So if everybody in this country who lost their job was re-employed in the hospitality industry, the unemployment rate would be 0 and their income would have fallen 60%. Do you understand what I'm trying to say? The problem we have is income. The unemployment is a cyclical phenomenon. It will go away. Slowly, to be sure, but it will go away. But the people who do not have the skills that put them in that 40% of the population that are benefiting, what are they going to earn? And this is not some evil conspiracy. This is something we're proud of, right? We are the most inventive nation in the world. This issue is bigger in the United States, therefore, than anywhere else in the world, because we implement technology better and faster. So that's one of the fundamental structural things that we have to understand. And the second thing is inflation. I told you we have all this debt, right? We have this massive amount of debt. Now, the amount of debt is unprecedented, but we have a history. This is a country which knows how to deal with problems, right? We are all able to deal with problems, and our country has 2 centuries of history of dealing with problems. Let's see how these problems were dealt with. This is a picture, you don't have to worry about it. This is just federal debt outstanding. Just federal debt outstanding. Hard to see. It starts after the revolution in 1790. Each peak, until the recent one, was after a war. It was the debt after the revolution. Then the one here is the Civil War, World War I, World War II. And in World War II, the ratio of federal debt to GDP was around 115%. Right? That's huge. You can see it fell dramatically, and it got down by 1975 to 29%. So how did the government debt, which was 110% of GDP, 120% get to 29%? Do you think the government paid it all back? No. We are clever. We are Americans. We inflated it away. After every one of these debt peaks, there was an inflation peak. What I've got on the right is the inflation rate from 1945 to 2011. Look what happened right after the Second World War. Oh, ugly. You had an average inflation rate of around 4 or 5% maintained for 15 years. Those of you who have done mathematics, take 1.05 and compound it 15 times. Then divide that into anything. And you get the answer. This is how you get 120% down to 29% without any hassle and without any repayment. So I can tell you, our country has a track record of doing this. It's also the only known way to eliminate that much debt. There is no plan B. There is no plan B. Okay? So, the only question that we as a society face is when this good thing happens. But it's going to happen because there isn't any alternative. So those are the two structural problems. The first one I talked about, this decoupling of prosperity from growth. This is a long-run fundamental one, but this thing is going to be big because the debt's big, right? I talked about federal debt of 120% of GDP. Think how much bigger things are today than they were then, and you get the general idea. Too many people owe too much to too many other people. It will never get repaid. It will have to be eliminated. One man's elimination is another man's life savings, right? You get rid of it. Someone's liability, everyone's liability is someone else's asset. That's what bookkeeping teaches you, right? Two sides. So every time you eliminate a real liability through inflation, you eliminate somebody's retirement income. And so all of this is going to be ugly, and it's going to be ugly for the next 10 or 15 years. So with that happy tone, let me remind you that we actually can invest our way through all of this as we have. A fundamental point I was trying to make was the prospects for an investor who has capital are quite good. If you can get through the next 2 or 3 years of turbulence, there's lots to invest in. That's a very different issue from what happens to the society as a whole. So, you know, we want to manage your money, all of it, just bring us checks, bring us cash. We want to manage you, we want to have all of you as clients. That's okay, and we've got things to do with these assets, but that doesn't do away with these problems. So let me finish there, and we can pick things up with questions later.